Ladies and gentlemen, dear friends, welcome to the first L3A E-Conference. Today we have two events in one. The first part is going to be with Stuart Sweeney of Raymond James, London, and the second part is going to be an incredible panel of global custodians. Today we have the CEO of HSBC Security Services, the CEO of BNP Security Services, and the CEO of State Street Luxembourg. So the first thing is going to be now the presentation by Stuart Sweeney, who is one of the most acute specialists of the industry. It's going to be a presentation on the global consolidation of the sector. Stuart, the floor is yours.
My name is Stuart Sweeney and I am the co-lead of the Financial Services Investment Banking team for Raymond James here in Europe. Just like to say, first of all, thank you to Serge and the conference organisers for inviting me to participate in today's conference and to share a little bit of my insights and views around the trends driving consolidation across the alternative asset administration market. Slightly odd experience presenting in a room in your own house away from a conference and without the feedback loop of the audience, but let me see if I can't do my best to keep it interesting nonetheless. In this context, I'd like to spend less than 60 seconds talking or sharing a little bit of background on Raymond James, but predominantly to focus on the four key themes as we see it driving growth in the sector and how this plays into the trends of consolidation. And then at the end, to share a little high-level sense for COVID dynamics and how these flow into to valuation. So I promised to try to keep the background on RJ to less than 60 seconds, so let me try to keep to that promise. So RJ, US listed corporate, extremely large wealth manager, but also global mid-market investment bank. We are subsector led, doing deals in the 100 million to 2 billion plus enterprise value range, premium brand in the US, emerging for us in Europe, having first landed here 4 years ago. We now have 3 offices across Europe, Munich, Frankfurt and London. And there are, from a greenfield standing start, there are now roughly 100 of us here doing investment banking in Europe. As you can see, when we talked about subsector-led, in the context of today's conversation, we're primarily focused on the technology and services and financial services subsectors. And my team and I have spent significant amounts of time over the last few years in and around the alternative asset administration space, both here in Europe, but also in the US. And below, you can see just a snapshot of some of the deals that we've been involved in and around this sector, not only of the administrators themselves, but also of the technology providers in and around this space, which we think is going to become increasingly important moving forward. So let's move on to the key themes. So today's focus from a key themes perspective are the 4 key themes that we see here and shown on the screen. Obviously, it goes without saying that ever-increasing levels of regulation is an inescapable fact and trend here, and they are a backdrop to everything that stands behind these four themes that we're going to discuss today. The burden of maintaining compliance for the asset managers and their clients is always there, and the alternative administrators have to try to keep up and remain laser-focused on these things. But in the context of the drivers for today's discussion, we are perhaps tilted slightly more towards growth and how the managers themselves are growing, becoming ever more global, more diverse, more complex, more technology hungry in the context of requiring more and more data. And obviously the administrators need to try to keep up. So the 4 key themes that we see shaping consolidation across the administration market itself are driven by a client need. So an increasing asset class diversification, the ability to scale with key clients across key geographies, an ever greater focus on specialization, and an increasing prevalence for technology and data solutions. And then obviously at the end, we'll look at how this all plays through into valuations. So if we start with one of the key four themes, the asset class diversification, there's no hiding from the fact that the alternative asset managers themselves are the beneficiaries of ever more allocation of assets to alternatives. We can see that here in the graph on the left-hand side, where all asset classes appear to be growing, many by double digits over an extended period of more than 5 years, be it private equity, real estate, debt, all of these asset classes showing impressive growth. But at least as interesting, if not more interesting, is the fact that the larger managers, the larger alternative asset managers, are getting larger. And this poses a completely different picture or problem or set of challenges for the administrators themselves as they look to keep up with their clients. Many of the alternative asset administrators were essentially born of their own domestic market and or of their own specific focus on a particular asset class and or service and or client group. But as those clients themselves win more in the market in which they compete, garnering and gathering ever more increasing larger elements of all of the funds that are raised, as you can see here, the larger managers are able to secure an even larger amount of the funds being raised. The admins themselves have to try to keep up and to give themselves the best chance to be able to serve their clients, be it in a new geography with a new service or into a new asset class, as the managers look for their administrators to provide services to allow them to continue to grow and focus on their business. This is clearly a fantastic opportunity for the admins and gives them the opportunity to fill the white space organically, yes, but where these businesses are backed by private equity in particular, value can also be created through selective M&A. And actually moving into a new market, trying to provide a new service requires new skills, new people, and in many cases trying to find ways of doing that organically is slow and doesn't give everyone the opportunity to stay at pace with their clients. And as the managers grow and the admins grow, the sorts of competitors that they're going to come across will also change, which may also require some degree of a quantum leap from a size and scale perspective in order to remain relevant to those clients. So we talked about the building on asset class diversification, but that's also true of geographical diversification. And as the alternative asset managers look to operate on an increasingly global scale as they chase investment opportunities, the administrators themselves need to keep up, again, a similar trend. And this is particularly true as the larger managers get larger. They look to try to find ways to reduce the number of service providers that are servicing them throughout the globe to sort of concentrate their spending power, but also to become more of a key client and to try to guarantee, to the extent possible, a standardized or homogeneous quality of service. A trend that we've seen during COVID, at least, is also that the managers themselves start to look for more and more management information. And of course, if you've got to go and get that from multiple different providers or suppliers, that makes the difficulty of the quality of the data also come through, something that we'll return to in due course. But also you can see here pre-COVID the emergence of the key players increasingly looking to focus their business around the key jurisdictions and particularly to mine the corridor of the US into Europe. And as you can see here on these graphs, they've seen lots of transactions between the US and Luxembourg in particular, perhaps a bit of a function of the fact that Luxembourg seems to be growing faster than market in the European context. And if we go back to the theme about looking of securing quality people, doing quality work with quality clients, in many cases it's possible to try to be able to do this, yes, organically, which can sometimes be slightly slower, although you can guarantee the quality perhaps under your control, perhaps easier, but at least as an initial step, looking to try to find scale, which is really key to your client. That's sometimes easier achieved by inorganic means, acquiring a company with particular technology or client base or skill set. And we see it here on this graph. But that's not to suggest that consolidation at the the top end of the market, which we expect to continue to see moving forward, doesn't completely negate the opportunity for specialists. We absolutely believe that as consolidation will continue to sort of rumble on, and the larger guys, as the admins look to service the larger clients, that there will be an opportunity for specialists to fill niches that have particular focus either on a client type, on a geography, or on an asset class. And we see plenty of opportunities for those niche sector or subsector focused players to grow in such a market as well. This could be a client group such as family office, which we know is increasingly the focus of many, not least in the fund space, as there's the confluence between GP and LP type dynamics. But also it could be a service-led proposition, and particularly in an area where some people have decided not to play, say a Manco space, where some people are looking for the checks and balances and arm's length relationship with a Manco, and/or the provision of services that some others, not everyone feels as comfortable providing, such as the provision of directorships, and/or a focus on this particular region, and so on. We continue to believe that there'll be opportunities here for many, particularly as some providers in key regions or geographies may be looking to build an ecosystem of best of breed. They'll look to plug in those providers in the key geographies, perhaps such as Luxembourg, in order to be able to service their clients in a coherent way. If we move on to the final key theme as we see it in the context of today's conversation, we're focusing on technology and data. Quite frankly, we've spoken extensively about this with our clients over the last 3 or 4 years. But what we've really started to see over the last 12 to 18 months is the fact that the clients of our clients are starting to want to talk to us about this, not least because they're looking for efficiencies, but also because they're looking to try to understand how they can become the value-add partner of tomorrow. So if we think about how technology has increasingly been used by the admins over the last few years, we've predominantly seen that people have been trying to look to focus on efficiencies and centralize processes and or lower the cost of delivery, and to become more efficient in the way that they deliver those services for their clients through some form of workflow automation or regulatory reporting, or in some cases even the use of technology to deliver water flow and carried interest calculations. But increasingly clients are going to be looking for new services, for access to their data in new ways, and or for more instant access to it. Again, going back to the theme that we talked about during COVID, many asset managers have been looking for more and more management information throughout this period, and doing this stuff bespoke off Excel spreadsheets and so on is increasingly complex, and quite frankly not necessarily the best use of time. Client frustrated, you're putting in a lot of effort, and maybe the data isn't always as homogeneous. But the most important question in our view is how do the admins of tomorrow morph themselves into becoming a value-added partner, so that they are able to support their asset manager clients not only on the efficiency point, obviously, but also that they're able to become a value-added partner by using the data or together with the manager that flows through them naturally in a way to put that data back to the managers to allow them to make investment decisions based on the data from their trusted partner, be that portfolio allocation, optimization, benchmarking, essentially GPLP data analytics. We see this as something that the top table administrators of tomorrow are going to be able to offer their clients to try to move up from being back office into something more of a trusted tech-enabled partner. Clearly, that's not going to be possible for all, given the likely capex and technology investment required. But actually, we think that to some degree it's going to be necessary as table stakes, as the larger admins go and end up competing with different people, not least tech-led administrators and or large banks who have larger pockets for capex spending around this space. But actually, if you want to be at the top table as an administrator, if you don't do this, there is also, I mean, at least intellectually, the risk of a disintermediation and you becoming potentially much more of a focused on a back office type solution provider and not someone who's considered to be a value-added partner. Again, no cliff event there, but something that we expect to see emerge over the next 3, 5, 7 years. And understanding how and where and why you want to play is something that many of the administrators are asking themselves today, at least of those clients that we talk to. But what you can see here is that there's an emerging landscape of parties who are able to provide technology in and around this space, either on the efficiency side and or on the value add side. And in many cases, they look to try to combine those two things, either specific to a particular asset class, to a particular geography, or a technology that provides a horizontal opportunity across all of these areas. This is an area that we've spent significant time in over the last few years and expect to be involved in more transactions over the next 12 to 24 months. But one of the questions that everyone's asking themselves really is, who's going to pay for this? Will the client pay for the technology? Is the capex warranted? Do we need to own the tech, or is it possible to just become a client of the technology itself? I guess the answers to some of that will also drive some areas of consolidation. But we also believe that the more tech-enabled partners are likely to be able to command a premium from a valuation perspective over time. Which leads us neatly on to the high-level overview of COVID-19 dynamics and how this is sort of flowing through into our current view of valuations. I guess the good news is the fact that the business model today, at least, is currently showing strong levels of resilience. Yes, growth, albeit at a different rate to what we had seen pre-COVID, but growth nonetheless. As one tech investor said to me, that is still an outstanding outcome in the current environment. But the subsectors still remains backed by long-term macro trends. And we can see how this plays through into some of the share prices and how they've rebounded and narrowed the delta between where they were pre-COVID to where they are today. But we think given the long-term fundamentals should continue, and that many of these businesses are going to be able to show resilience through demonstrable KPIs about how they not only didn't lose clients, the churn remained low or non-existent, that they're able to increase share of wallet. We've seen lots of examples of existing clients continuing to buy more from the same service provider throughout COVID, and also still be able to show some level of relative growth. We expect that ultimately these sorts of things should be recognized by investors. So in conclusion, the alternative asset managers are growing, are becoming more diverse, more complex, and have ever-evolving needs. And it's incumbent on their administrators to keep up. The macro backdrops for the sector, for COVID, all being what it is, the long-term prognosis for the sector remains healthy. And the larger admins, as we talked about a little earlier, are going to need to keep up and be the value-add partner of the future, which is going to require investment in skills, in technology, and footprint. And the larger admins are likely to consolidate further the market opportunity, and predominantly going to be led by inorganic growth, at least in the short term. And whilst that consolidation trend will continue as people seek scale, we also believe that the specialization will provide opportunities for niche players in regions, in asset classes, in specific services, and particularly around providing bespoke services to particular client groups with particular needs. But ultimately, 5 years out, we expect to see the market more consolidated than it is today, with the independents, as we call them, competing increasingly with the large-scale tech players and or the banks globally, or at least across the axis of Europe and the US, and also ultimately being more tech-enabled. So hopefully some of that was interesting, and I look forward to having the opportunity to meet some of you in face-to-face in due course. Happy to take questions, otherwise I hand back to the conference organisers. Thank you.
Many thanks, Stuart. What an industry indeed. And now we are going to have three of the most important players of Luxembourg for this panel. I want to welcome Eduardo Gramuglia, who is the CEO of State Street, Robert van Kerkhoff, who is the Managing Director of BNP Paribas Securities Services Luxembourg, and Niccolò Paoli, who is the CEO of HSBC and HSBC Securities Services Luxembourg. Guys, let's have a great conversation now. Robert, Niccolò, Eduardo, it's a pleasure to have you today. Really a pleasure. I have the first question for you. I mean, in order to understand what you're dealing with, I mean, is the percentage of private equity real estate assets that you deal with, you administer in your different companies. Maybe, Robert, you want to start?
Yeah. So currently our ratio is around 17%. That is let's say all the drawn lines. If we certainly when we draw a line, let's say within a couple of years, which I think is pretty feasible, we will go to 25%. That is our current ratio.
Okay, thanks. Niccolò?
Yeah, so first of all, thank you for inviting me. Pleasure to be here and to represent HSBC on this. If I look at our portfolio of alternative assets, so PE, RE, and also debt infrastructure, we're approximately at a quarter of the portfolio is represented by that. And I think the growth plans are for that to be growing faster than traditional. So we'll probably be around 30-35% in 2 to 3 years' time is our expectation. We have more launches in the alternative than in the traditional. So, yeah.
Very good, thank you. Eduardo, how is it at State Street?
So, good afternoon. Yeah, at State Street, I mean, considering that we have a book, we service now assets north of 1 trillion in Luxembourg. I'd say that in the alternative space, and our alternative covers anything from liquid alternatives to private equity, real estate, debt. I'd say that the more liquid side of the spectrum, which is what you're asking about, is we're around 10-15%, and that's growing. We've seen a lot of the projects that were on the pipeline, our clients' projects on the pipeline, were not deterred or, let's say, suspended or slowed down by the COVID crisis. So we're quite bullish. We're working on a number of opportunities. So yeah, I'd say right now 10-15%, but that's going to increase. Now, obviously, you need to take everything in context across the spectrum of alternatives and the broader book of business we have.
Eduardo, do you think it's going to increase because I mean more and more investors are looking in that
Yes.
asset class?
Yes, I think there's a definite demand. We see it both from the investors of our traditional clients, but also asset owners in their own right are setting up their own structures in Luxembourg and launching these products. So you have all the investor, let's say more your retirement, etc. But then you have a definite wave, if you want, of asset owner trend of asset owners, and not just European, also from other corners of the world.
And on that 1 trillion that you administer, what do you think in 3 years the split is going to be?
Well, I mean, if you look at the way things are trending, I would go to a 20-25%, bullish 25%, because it's quite a bit. But I think what makes me say that, if you look at the broader trend of flows in Luxembourg and manufacturing, you've seen that the flows are still going into your traditional uses. Those are the funds that scale, and therefore it's easy. But from a manufacturing perspective of new product, you see definitely the alternative side has taken over the usage side. And so you see more projects around ACE, RIFEs, SIFs, all the alternative regulated and non-regulated. We should not lose our focus on that, because that's an important part that sometimes escapes, let's say, the surveys and the statistics.
Sure. And Robert, at BNP in 3 years' time, what is your expectation?
So we have a very clear strategy on what we call the private capital space. So we have quite a clear, and we will explain it later on, a clear strategy around the people and technology. So we want to achieve 25%. And perhaps what is more interesting is also to mention is that also the margin on this asset class is, let's say, a little bit higher than the classical business. So if we take a look at it, I think it was Boston Consultancy that had a nice report around that. So they say that 17% of the assets under administration, more or less, are contributing to a 47% on the revenue pool. So that is, I think, also something that we should not forget.
And you think this is sustainable? Because on the classical liquid assets, I mean, we have seen that the margins diminished, and there was a huge investment in technology. Is it going to? Are you going to be able to keep those margins on the private assets? And second question is technology the only option forward?
So if you talk about the challenges, right, that you're mentioning, and the fees pressure that we are facing, that's I think in the whole value chain. I think we are also, as providers, we are noticing that. So therefore, I think it is important to make sure that also from a client selectivity perspective, also from a cost-based perspective, that we are making sure we're doing the right investments. I think now more than ever, and I think that also the word of partnership, making sure that you have the right clients who wants to grow with you, is now, I think, also a very important topic that at least we are looking carefully at. So if you talk about the growth on the business of private capital, I would say yes, we strongly believe in that, because we have that very clear strategy.
Nicolo, at your firm at HSBC, is technology going to be also the leverage to make sure that you're going to gain more and more on those private assets administration?
Yeah, so I think, the margins are certainly higher in the alternatives. Will that last? Probably not. I mean, everything gets eroded over time, so we have to not be complacent on this and make a play on efficiency, but then also additional services, right? And that's really what we're at. So the technology is the clear one around gaining efficiency, but also adding additional services. And as a company that is present in multiple jurisdictions, it's not just about the offering here. A lot of our clients are global. So we need to make sure that when they connect to us, they connect to one HSBC, and it feels and looks the same across the globe. So the way we do that is certainly around technology. That will create the one platform and create this more homogeneous client experience. And that's the way we try to service the client, keep them happy, and obviously keep our margins as healthy as possible.
And do you have a proprietary technology, or do you have a technology in the market?
So it's interesting. We, as a firm, we used to be very much, and I'm talking globally here, we used to very much build our own, and we thought nothing was good enough for us, and would take things and then build it. And what we've realized is that might give you an advantage with your current customers for a little bit, but over time, it requires a lot of investment. So the better one now is to take platforms and systems that are readily available, that your customers already use, perhaps tweak them a little bit as needed, but not too much, because then you change it and it's hard to get servicing at a good cost. And instead add different types of value, right? So one for us is clearly the global element of things. If you can actually access a TA platform here, but then access it in all the other jurisdictions in which we operate, that's beneficial. the other thing we work on, I don't know if we'll talk more about IT, but APIs and the way you connect to us is a huge thing for us. So we're trying to make that connectivity to us as seamless as possible. But our core platforms are generally going to be more off the shelf.
Okay. And Eduardo, what is your strategy in terms of technology? Is it, to use your own systems? Is it to use existing systems, to acquire IT companies or tech companies in the future?
Well, I suppose if you look at State Street, it could be, you can say it's all of the above. I mean, we just acquired Charles River Development, which is a front office system. But if we look at specifically the alternatives, the real estate, the liquid asset side of things, well, we have a system that came through an acquisition, Morgan Stanley, back in the day of the previous crisis, the GFD, the global financial crisis. But if you look at the expansion, so you expand organically, your clients are launching more products, you're in an existing technology platform that then you look to optimize and improve, digitize, whatever. But then if you look at some of the mandates that are out there, which are also part of the expansion, might be clients or prospective clients that are doing it themselves, and because of growth, because of they find it's not core anymore, asset managers decide to outsource. That will have a component of technology potentially, because at the beginning, the prospective client might want to continue not to be disrupted, be continued on their current system, and then we will migrate them, or maybe we'll find that the one that they have is better than ours. Rarely happens, but it could. Some acquisitions are done for that reason as well. So it's a bit of a blend. I'd say that ideally, we have the systems ourselves, and we want to continue developing those. They're not internally developed. We work in partnership with technology companies. We're evolving. Now, I guess to the IT point and the criticality of technology, you also need to think that a lot of the alternative fund models, the funds that are coming to market, are starting to what we call be hybrids. Illiquid assets with people that want daily liquidity. Maybe daily liquidity is a bit of a stretch, but a bit of more of an open-end type fund. And so at that point, we're starting to merge and let's say adapt our operating model, bringing basically technology that you would have originally said traditional or technology that you use to price your normal funds, your traditional funds, into the more alternative world, depending on that type of new product, hybrid product that's coming to market. So I think technology is and will remain, for several reasons, critical and at the forefront of any expansion or growth ambition. Cannot do without technological considerations.
It's quite interesting what you're mentioning now, and the fact that more and more you have hybrid and type of products, but also global asset managers, with liquid and alternative assets. I wanted to discuss with you, what is your perception of the independent, the difference between the independent asset managers, not asset managers, sorry, administrators, and the global custodians as you are. You see, all the independent administrators came from the SPV administration and went into alternative fund administration. You came from the liquid assets administration and went into private equity and real estate and infrastructure, and also now into SPV. So those two worlds are now, on the same, not exactly on the same market, but there are a number of overlapping. What is your perception, Robert, of that?
Yeah, so I think, of course, there are different histories also. I think the way these have grown, and you explained it pretty well now, that we have grown from more on a usage, usage perspective. That now we see that there is this interest from our clients in this area of private capital. So what we did is we tried to find a way where we put again people and technology together. And I think what's the element of success until now is that we have all the elements from an IT, from an operational perspective, we bring them together. We have the change element also, and that I think makes it within the big company that we are. So we have more here in Luxembourg, more than 1,000 FTEs working. So we try to keep there some agility in that space of private capital. I think that that is working out, I think, well. From an, let's say, from an also financing perspective, from an let's say complete range where we do the fund administration, depot, custodian, but also there the financing on the liability side and on the asset side. I think this is the strength to be able. And then if you look at within the BNP Paribas group here in Luxembourg, we also can offer there the commercial aspect of cash management of the SPVs that are below the structure. I think that altogether is a pretty differentiator.
Yes. And Nicolas, I mean, is size, I mean, a differentiator? I mean, for example, can you onboard small funds, for example, small private equity funds at HSBC?
We can. Let me maybe just sort of tackle the other question. I mean, I think the big differentiator is balance sheet and the fact that it is regulated, which nowadays it has pros and cons always. When you say something is heavily regulated, I think people go to the negative, but the positive is it's protected, right? There's a protection, there's a security element to that. And I think the independents grew, they reacted more quickly. They were more agile at the time to react to change and to new things coming into the market. And I think we've come along. And it's taken us a bit longer. There are always pros and cons. So I think and I'll speak for myself, we are slower to react, but when we do come along, then we have a certain amount of security that comes along with that. It's similar to when I think of fintech in general, right? The fintechs, when they do come in, they are more of an enabler for us and they help us. People say, are you competing with fintechs? And I think often the answer is not always, right? Because we do two very different things. And you've asked about size. We have a $2.7 trillion balance sheet globally. That's not easy to replicate. And that provides a certain amount of liquidity as well. So when customers need $1 billion, they will go to a bank, not to a fintech. When you need a solution in Hong Kong, Luxembourg, Ireland, UK, the US, again, you turn to more global firms. And that stuff is not easy to replicate. So I think that is how we tend to differentiate ourselves, and we move in a very determined fashion in that way, and that's around producing that global experience, which means we might miss a few things along the way, right? That more agile players can take. In terms of onboarding smaller funds, could we? Certainly we could, but it's not where we have a competitive advantage. Our competitive advantage is on global firms that want to operate, like I've just mentioned, right? That they need access to our balance sheet. They need access to our capabilities in different markets. So could we onboard a smaller local fund? Yes, but we don't.
I understand. Eduardo, the fact that, for example, I mentioned that the independent administrators came from the SPV world. Are you happy to administer SPVs now? I mean, under the funds you also
absolutely we do it. So I think overarching the theme is the convergence of alternatives. Alternatives becoming mainstream. Your traditional large manager, their investor asking them for new product, new alpha, and pushing them, and by definition them pushing us to change, to evolve. And then you have the more boutique type asset manager with a different type of audience, a different type of investor that requires a more maybe nimble administrator. I think by and large, the expansion of the growth in alternatives, we all have our differentiators. I think the growth is given an opportunity to everybody. It's just being able to stay ahead in terms of nimble whilst offering the protection, as Nicolas was saying. I mean, we can all talk about our balance sheet, but by and large, I think the asset owners with the large mandates, with global distribution, the asset managers with global distribution that require global footprint, that's likely going to becoming our way. The administrator for the smaller mandate, which maybe we're not so keen in doing because of requirements, because of maybe even fee pressure, As you say, the fee pressure is not is coming into the traditional world as the alternative, especially as you see the traditional managers moving into the alternative world with the same investors. And so there's some business cases that make sense and some that don't. And I think as long as we all manage our books in that way, then we all make it sustainable business, which is by and large what you want to achieve at the end of the day. Because again, there's a convergence, there's growth, and I think there's opportunity for everybody.
Well, what do you think are going to be the next opportunities? What are going to be the new needs of the market and the new trends?
Multiple. I think, well, in a way, is catering to these products that are starting to be hybrid, taking features from both worlds, because you want the asset that delivers you the return, but it's required by an investor that in the past could not access that asset, and now maybe can through different regulatory changes, but still requires certain reporting, etc. So that's one aspect of it. I think ESG and the ESG world coming into the alternative space, we're seeing more and more of that, especially in the loan. I think with that segment, I'm not sure, I'm probably going to get criticized if I call it segment, but with that part of the investor preference being there, data is going to become paramount. Because in order to prove that your product is ESG compliant, you will have to provide a whole set of data, both to the investor, but also to the regulators, to continue having a label. So I think in that respect, and then, yes, and then the funds evolving and people coming with new ideas, I guess that's the work for alternative. That's why it's called alternative, is because anything is not going to be equal to the previous one.
Niccolo, anything regarding the ESG? I'm not speaking of greenwashing, the real ESG.
The real, no, not greenwashing.
Making good on society.
So I'm glad you asked. So I agree with everything Eduardo said around this, around the more need for data and services, and the ESG segment or trend, or whatever we want to refer to it as. I remember. I'm sure we all did. We all studied the efficient frontier of investing, right? You had risk and you had reward, and you had to try and find the right way to get risk and reward. And I think that's a concept that is now very well embedded. I think the next concept of that is going to be risk and impact, or reward and impact, right? And that's where ESG comes in. So a question we couldn't answer today is, right, I'm going to invest my money. I can get more or less, what I expect the returns to be over a long period of time. People can tell me that, and they can give me my estimates. But what about impact? Where am I making the impact? We can't really say that. We can say we'll avoid things. We won't invest in transition, fuel, coal, or other dirty ones. But we can't say, are you going to make an impact more in water, or more in children's education, or more in women's rights? Or we can't quantify that. And I think the next sort of 10 years will be categorized by a much more sophisticated ability as an investor to say, I want to put in my money, I'm fine with getting whatever return, but I want to be able to direct my impact in a certain way. So I think we're going to see something along that.
And again, to have data in order to be able to prove it.
Yeah, as opposed to, and this is the quantitative versus qualitative, because we all write very long ESG reports about all the good stuff that we do, and it's all true. But how do you quantify it and then be able to go to an investor and say, right, you want more water, or you want more clean air or oceans, or what is it that you'd like to do? And then say, right, we're going to direct you to this fund or to these companies or to this bond or this whatever.
And Robert, we have seen that there is a lot already in the financial markets. So listed securities. There is a lot of ESG benchmarks and standards. There are very little in the private markets so far. And do you see it only as making sure that it's impact investing, or even wider than this in terms of to make sure that you can prove that you are not badly impacting the society as a whole?
Yeah. So I think for me it's a topic is not easy to answer this question. If you look at the ESG, I think there was a lot written. I think if you look at the private equity market, there's still a lot to standardize. And I think that is, for me, if you would give an answer that you raised before to Eduardo, I think that is where where the industry currently is. So if you look at the institution of ILPA, they are helping and guiding us, to giving some principles, especially to the LPs, which I think is very welcome, because that is important, the standardization. So if you then ask me what is the next, let's say, challenge will be for me, outsource more of that investor reporting or portfolio reporting that is currently done by management companies. I think there we can help them and play a role. If you look at that ESG, I think for me that's the next step. So what we are looking at is indeed a data, trying to find consistency across that complex change, which most of the time very manual, and to make sure that the first thing is, we begin with the fundament, which is, consistent data from end to end. And then I think the next step will be to make sure that the user experience on the other side, which is the client, can have access in a very easy way to this digital dashboard or access to a platform or to a portal. This is something that we are now in partnership with the fintech called Asset Metrics, to make sure that that we provide that information easier to the investor
On an ongoing basis.
On an ongoing basis, on a day-to-day basis. Secondly, we are going to provide the performance and risk. And the third one, which will be, we provide the data for the ESG. And I think this is a little bit how I see it. So to kind of build it to a next level.
Thank you. Nicolo, any other challenges ahead for the industry, the administrators in the administration industry?
Well, I mean, I think we've talked about a lot. I think with the lower margins and the technology, and now COVID as well, obviously adding to all of this, low interest rates, if not negative, we haven't gone there yet, but all of this hits banking in Europe particularly hard, and it's a very challenging moment. So there are a lot of challenges, but I think one thing that I've realized through COVID, and I don't know if it's there or not, but it's the resilience of people, and I'm sure everyone would echo this, which is, if you had said to us last year, get 97% of your people to work from home within, a week or two, we would have said it's impossible, you're all mad, would go bust, and yet we did it. When the challenge comes, we face up to it. So we've talked a lot about digital, we've talked a lot about, ESG and things like that, but at the end of the day, it's also a people business. And so we should never forget that. We're talking, people talking to people, to clients, and that will always make a difference. So I think, that's another challenge, is to keep talent, retain talent, attract talent, and make sure that they're up for all the challenges that get thrown our way in 2021 and beyond.
And it's a big challenge on the Luxembourg market.
Yes. Yes.
And do you think with what happened with COVID, the fact that people, can work remotely,
yeah.
Are we going to source talents much further than what we did so far? Because we went to the borders mostly.
Yeah, so you might be asking the wrong person, which is I source a lot from within the group, because we are a relatively complicated organization and we have a lot of local talent already, so I want to bring in some that know the group better, because our big push is around group connectivity and making sure that anyone who connects with HSBC feels like they're connecting to the group in the same way worldwide. So I actually take a lot of my new recruits from different parts of HSBC and I bring them in.
But it means that you import them here?
I am importing them.
Do you think in the future you're not going to import them?
Yeah.
They are going to work remote from Ireland, they are going to work remote from, Cayman, or I don't know which place where you have the right workforce with the right talents?
It's a really interesting question, and it does, it's probably a sensitive one too, and it touches on, how much can we outsource, maintaining control. So I know the regulators have a view on this in terms of percentage of people, or percentage of activity, or percentage of your cost base. I know we bump up against some of these things. I know also some activities are less likely than others. So I think what this has done is it's brought the debate to the forefront. And now we will be talking about this, because we can sort of say, look, we've proven that it does work, at least for several months at a time. We've gone and done the test. Can we be looking at a different type of model? But I think it will take a while. We were talking earlier about employees now wanting to return to their home countries and say, look, it's beautiful in my home country, I'm Italian, I go back to southern Italy, can I not work there for 3 to 4 months? Right now, we don't feel comfortable with that, to be honest, as an organization. We might get there, but again, it takes time and it takes steps, so we'll see.
Eduardo, you already have people working from far in the group?
No. The reason being that, as Nicola said, we do outsource a lot of the work and delegate to other. We have sites where you have a global footprint that allows us to balance work, so on and so forth. It gives a scale. In terms of the population that works for the bank here in Luxembourg, needs to be resident in Luxembourg or in the bordering countries, and that's one of the things. It's rare to have somebody resident far away. The implication of that, because we're all, I think, analyzing that, is that there's still some regulations which need to be bear in mind as social security. So if they're working for a Luxembourg bank but living somewhere else, what is the social security aspect? What is the tax up? What is the impact to the employee? What is the impact for the company? But more importantly, we're a regulated company with the supervisor. If we start moving these functions outside borders and concentrate them in one location, then it creates a permanent establishment type of consideration. Do we need a license in that country to be able to have the people in that country? So it introduces a lot of complexity. As Nicola says, we're all looking at this because clearly COVID has demonstrated that we can do it, that if push comes to shove, a lot of the workforce, 98%, was working from home. Not just here, but also in our delegated sites across the world, in Poland, in India, in China. And that gave us, as we saw the virus travel, it also gave us the possibility of shifting work from one location to, depending on the situation. So that is all good. Now, moving to the next level, life after COVID, I call it. I think COVID has demonstrated that it can bring a work-life balance to our employees that has, hasn't been imagined before. We've seen a lot of employees that before would say, no, I'm not going to work from home, it's got the kids, it's disruptive. And now they need to come back and it's like, can you come back please? And it's not an obvious thing. I mean, I think the balance has changed. Where is that balance going to fall? I don't know. But I think pragmatically, we need to look at, okay, our IT infrastructure, I think there's room for improvement, so what improvement do we need to do that? That should be easy. Regulatory framework, a bit more tricky.
But it will change, because the CSSF already mentioned that they are going to issue a new circular.
Correct.
With a new mindset.
Correct.
Because they have seen what works and what can happen in the future, because this pandemic, I mean,
and
it's maybe not the latest one.
And the Minister of Labour is discussing about 1 day from home, obligatory télétravail, but that already starts to become a bilateral. It's not just Luxembourg anymore alone, it's a bilateral conversation. And then Social Security is a multilateral consideration because that's the OECD. So we need to, I think we're all for it. I mean, it creates, for the environment, if we go back to the ESG theme, for the environment, less people on the roads, less cars, less, gas, it does have a positive impact as well. So it's all things that we need to put on the balance.
It needs to be balanced, absolutely.
Absolutely. And then to your point around, now I can go and hire somebody in another corner of the world and make them work for the Luxembourg operation. Admitting we don't have all those problems of regulations and all that stuff anymore. One of the things that we found is mental health. People were not used to working so distant from their colleagues. And the daily interaction that
so it's not only because of their spouses? Or the kids?
I don't know where this is going to be broadcast, so I'm going to reserve that response just in case mine is listening. But no, I think, if you look at the population that wants to return to work now, a lot of young young employees that have been secluded in their apartment for 3 months, not being able to talk to anybody physically. There's that aspect that needs to be also borne in mind.
For sure. Robert, any lessons learned from the COVID period, which is not fully over? But,
definitely. So I think from, because we are a big organization, but also governance in place. Some of them, perhaps, at a certain moment will delay certain decisions. And I think what we saw is that as we had one target, everybody in one direction, somehow agility came in and made it much more easier to work. And also some of the governances that disappeared, I would say. And then you come back to what you were saying before. So we also have that regulated aspect. So we need to find a balance there. So what I've learned, that we very quickly we were able to have almost 100% of the people outside of the company working from home. Something that we all the time we discussed and we never came to a certain conclusion. And there were tax issues and there were other issues. And now suddenly it could happen. And I think this is what for us was a very positive aspect of the COVID crisis. I think also what we have seen is that technology again is very important. So also on the digitalization where we let's say invested a lot and we changed a lot, that helped us as well, to make sure that we were stable during the crisis. But I need to also make one comment. I think from a BAU perspective, our clients were saying, "Good job." It was stable. Technology was good. On the other side, I think there are complex change projects where we see that requires that there are multi teams working together and making sure that that we in a kind of DevOps mode make that progress, and that is where I think the challenge is. So the challenge is not on the BAU, but the challenge is much more on the change side, where we have some complexity. We need to have people from different angles working together, and this is, I think, where the challenge is from a working from home perspective.
Very good. Maybe one last question to each of you, especially as we are just not even out of the crisis. What is your view on the future? Are you optimistic or are you pessimistic about your own business, about the industry, about the marketplace in Luxembourg for the years to come?
Yeah, so I'm optimistic by nature, so it would be strange that I'm saying now I'm a very pessimistic view on that thing. So now I'm optimistic. Coming back, I think we have a clear view on our business. We're investing in people, and it's not easy because we're all chasing the talents in the market. Same time, I think we on the technological side, I just explained. So we are working on that, developing that platform. And also making sure that we are with the partners that we are working with, making sure that we bring that client experience that we think is positive. So on that side, I think we see and we hope to maintain that growth. On the other side, I think we see actually that the onboarding is slowing, and I think that is something that probably we see in the whole market. And I think we need to be extremely vigilant. Vigilant on liquidity, because I think it's I think until today, a lot of the things have not been clarified. A lot of indicators are somehow tapped by, I would say, institutions or are not clear. And I think until that is not clear, we need to be extremely vigilant, and especially for me, on the liquidity side. So therefore, and that's a little bit, perhaps the marketing answer I would like to give. I think what is very important here is also from a financing perspective to make sure that you have the right partner next to you, because there will be certain moment need for more liquidity, and I think there it's important that this relationship that you have is very clear.
Thank you, Nicola.
Yeah. So look, on the whole, optimistic as well. I think cautiously optimistic. Given what we've got out there, but interest rates are low, liquidity is still at an all-time high. There's a lot of money chasing yield. which is going to favor alternative assets. Luxembourg is well positioned for that. We're positioned well within that. Our current client base has a lot of projects, and we can see, when we look at the pipeline for the next 3 to 4 years, we think we can double revenues in this market. So very, very positive.
Definitely optimistic.
Yeah. Well, let's see. That's what the pipeline says. So we're very positive on all of that. I think the challenges are what we've said. COVID, at the beginning, it wasn't clear where it was going to go. And maybe we haven't seen the last of it, and maybe we haven't seen the full economic impact. So to Robert's point, we do need to see what happens with liquidity, with the credit, with the economies in general, and how that can impact, right? Because it could have had a very negative impact. So far, it hasn't. So that's a big one that we need to look at. And then the other one is digital is extremely promising, and automation, all that is very promising. We do need to deliver on it, and that's always relatively challenging. Doing it in the right timeline, doing it quickly, doing it properly, so that we can keep the margins where they need to be. So it's not without challenges for sure, but on the whole, cautiously optimistic, I think, is the phrase.
Thank you. Eduardo?
Yeah, I guess we were all optimists around here. Glass half full. I'd say probably if you had asked me this question 12 months ago, I would have had no clue of what we just lived. So it's very difficult to make a prediction in these days. Having said that, like my colleagues, I'm optimistic about the growth in Luxembourg, the success of Luxembourg, the success of our institutions to capture that growth. I think that's going to continue coming. Concerns how long will this situation last? Because quite clearly there's ups and downs. By different in different ways. A lot of countries have normalized that curve, have lowered that curve, have flattened the curve, and now we see cases here and there, outbreaks, localized or extended. How will that then translate into the real economy? Given that right now a lot of it is being held through government action or supranational action, the European Union, the United States, putting different plans. What is the longer term impact of that? I don't have a clear view right now. So that is a little bit of a concern. But look, we've learned very important lessons. I think the more important one that was when it was the employees' health or people's health, that was a priority. It became a priority for everybody, for our organizations, for the regulator, for the government, and everybody did the right thing. And that's how we're all sitting down here and telling this story. It could have gotten worse. For the rest, we'll just plan to get back into some certain normality. We'll learn the good lessons that we learned from this. We'll try to keep that. I think we need to keep that momentum and do it while it's still fresh in people's memory. Financial industry long-term memory, I think, is 6 months. So we certainly need to take advantage of that.
Thank you. I asked the same question to a friend of mine the other day, and the guy told me there are two ways of looking at it. According to two different views. There is the optimistic view and the pessimistic view. So I asked him, what is the optimistic view? He said, in the next 5 years, we are going to eat dirt only. And I said, what is the pessimistic view? Might not be enough for everyone. So I'd like to conclude on this joke. It was really a pleasure to have the three of you in the same room, with the COVID distanciation, and everyone with a mask. So we have been extremely careful, extremely prudent. That's what we are asking our own people in our own organizations. And let's make sure that the energy that we felt during the crisis to make sure that we were able to give a good service to our clients is going to remain in the months to come. Thank you very much.
Thank you.
Thank you.
All, I hope you enjoyed this first e-conference, which will be followed by many others. I'd like you to stay tuned on our website, which is l3a.lu, and join us to bring our voice, the voice of the industry, on this incredible market, Luxembourg. Thank you.